Dare to imagine this. What if money wasn't controlled by a single authority? This is Bitcoin. No banks, no intermediaries, and no borders. A new financial system built on technology, trust, and freedom.
Bitcoin represents a fundamental shift in how money is created, stored, and transferred compared to traditional banks. It operates on a decentralized network that does not rely on governments, financial institutions, or central authorities. Unlike banks, which control accounts and transactions through centralized systems, Bitcoin is maintained by a global network of participants following transparent rules encoded in software. This structure removes the need for trust in intermediaries and replaces it with trust in technology. One of the most significant differences between Bitcoin and banks is decentralization. Traditional banking systems are controlled by centralized entities that can freeze accounts, reverse transactions, or limit access based on regulations or internal policies. Bitcoin, on the other hand, allows users to hold and transfer value without permission from any institution. As long as someone controls their private keys, they control their money. Accessibility is another area where Bitcoin stands apart. Opening a bank account often requires identification, documentation, and approval, which can exclude millions of people worldwide. Bitcoin only requires an internet connection and a digital wallet, making it accessible to anyone regardless of location or financial background. This feature positions Bitcoin as a powerful tool for financial inclusion. Transparency also plays a key role in distinguishing Bitcoin from banks. Every Bitcoin transaction is recorded on a public blockchain that anyone can view and verify. This level of openness reduces the risk of hidden manipulation or undisclosed practices. In contrast, banks operate with private ledgers that customers cannot independently audit, requiring blind trust in institutional systems. When it comes to money supply, Bitcoin follows a fixed and predictable model. Only 21 million Bitcoins will ever exist, creating digital scarcity. Traditional banks operate within fiat systems, where central authorities can increase the money supply, sometimes leading to inflation and reduced purchasing power. Bitcoin's limited supply appeals to those seeking a hedge against inflation and currency devaluation. Speed and efficiency further highlight the contrast between Bitcoin and banks. International bank transfers can take days and involve high fees due to intermediaries and currency conversions. Bitcoin transactions can be completed within minutes and sent globally without borders. This makes Bitcoin particularly attractive for cross-border payments and remittances. Privacy is another important difference. Banks require extensive personal data and track customer transactions as part of compliance and monitoring processes. Bitcoin transactions do not require personal identification, and users interact through wallet addresses rather than names. While transactions are publicly visible, personal identities are not inherently tied to them, offering a different model of financial privacy.
Join our crypto community. Get updates, analysis, and collaborate with like-minded people. Exclusive events and webinars too. Link in bio. Claim your rewards. Click link below.